Precious Metals panel. So yeah, without further ado, given you're all ready, I'll hand over to Gabriel Alonso-Mendoza of Amvest Capital and leave it to you.
Thank you. Thanks, Alice, and thanks everybody for being here today. Good morning. We have with us some wonderful people on this panel today, starting here on the first chair on the left, Coille and Alphen from Equinox Partners, Kimberly, founder and CEO of Lahontan Gold, Dan Oliver from Myrmikan Capital, Suki Cooper from precious metal analyst at Standard Charter, and which is a bank, and James Steele, who's an analyst for precious metals at HSBC Bank. So good morning, everybody. We're going to kind of keep it macro here in terms of the talk on precious metals, try to keep it light. And they've sent me a series of questions, which I'll go through those. And then I'll just maybe ask a couple of my own, just because I'm curious on everyone's views. But maybe we'll start with something sort of light and easy. I guess not easy, but something that maybe everyone's got an opinion on. Hard to always tell, but if I can just kind of go down the line, and if you guys can give me like a range of where you think gold will trade in 2024, and maybe like whatever kind of range you want to do, but just quickly across the line, just so we kind of see where everyone's head's at for next year. If you want, I'll start.
I guess I'm going first. I'm first in line. I would say, a range, probably 1,800 to 2,400.
Well, that's a little bigger range than I was thinking. 1950 to 2200.
Yeah, I'd bifurcate it. So either we're going to have a big deflationary crash and gold's going to go down, probably not as much as other things, but looking at a test of 1,700, or else the treasury bond market breaks. We probably run at 2,300 plus. So it won't be where we are now. It's skewed on both sides.
My range is slightly narrower. I do think that the macro headwinds are likely to come back to the forefront of the market, so we could see a dip below 1,800. So at the lower end, I'd say 1,775 seems reasonable. And at the upper end, I do think we could reach all-time highs, so back up to 2,070 seems reasonable as well.
What I can give you is our average price for next year, which is $1,825 per ounce. I think our low is 1750 up to 1950, 1925. Don't quote me on that, however, but the average, which will be weighted to the downside, is 1,825. I'm more comfortable giving that number predicated off of a firm Fed going forward until rate cuts second half of next year and a strong dollar.
Okay. So that's pretty interesting. I think I grabbed from all that probably not necessarily a massive bull market next year, but kind of a more tempered market and maybe reminiscent of some of the pain we've all felt this year in the precious metals markets. So just I guess going forward, right? And we're talking about next year because we're optimists here. And so in terms of what we're seeing in terms of your portfolio positioning, one of the questions I've been told to ask is about positioning your portfolios to protect against inflation. And I think everyone's got their own sort of ideas and how they manage their portfolios. But maybe if I start from the sort of the banking side, James, what are you recommending to clients in terms of best way to position portfolios for inflation, the inflation we're seeing now, and it can be gold, or it can be other things?
Well, my remit is on precious metals, so perhaps I should really concentrate not on what the bank advises on inflation, but how I think gold works for inflation. I think it's a big mistake to look at inflation and necessarily react to the gold price. And you see this split between institutional and retail clients a lot. And last year, retail clients bought directly on inflation rising, and they were right. Institutional clients tended to sell, as we saw by the liquidation in the ETFs. And here's the reason why. When a hedge fund manager, I'm not speaking for all of them, or pension manager or asset manager looks at inflation going up, he doesn't look at inflation. He says to himself, what is the anticipated monetary response to higher inflation, in which case would be higher interest rates, which would lead him to liquidate gold. And whereas the man on the street doesn't go to the second derivative. So higher inflation won't necessarily make you want to buy gold. Lower inflation may in fact do it if you think it's going to cause the monetary authorities to cut sufficiently.
Great. Suki, what's your view?
I think that's a very valid point, just seeing that dichotomy between the way investors responded to a higher inflation environment. Similarly to Jim, we don't have a recommendation for a certain percentage within the portfolio, but looking at past trends, the way gold has reacted to inflation, it doesn't always respond to an inflation environment. And it's really only periods where inflation is above 5%. And if we go back to the 1970s, it's during periods of high and unexpected inflation that gold tends to become a very good hedge. So we don't believe that gold is an effective inflation hedge all the time, but it can be used as a strategic inflation hedge. And certainly we do tend to see that the monetary response is very important. But I think also in the short term, if you buy gold after inflation has picked up, you may not necessarily see its value. So it most likely needs to be held in a portfolio over the duration and ideally before inflation starts to tick higher. And many studies have shown that period needs to be like almost 18 months before that unexpected inflation materializes.
Well, first, let me just say I'm delighted to hear all the very conservative price targets for gold. I was at a dinner in 2011, and the same question was asked, and gold was knocking the door of 1900, and all the responses were universally 2000 and above, and of course, it's a very different outcome. So I'm glad to hear the consensus so conservative, because I'm a lot more bullish than that. And what I would say about portfolio positioning, I'll give two quick anecdotes. One is my wife likes this soap from France. It's very fancy soap. And it was $7.50. It cost $7.50 a bar 2 years ago. Now it's $15.50. Right, so it's gone up 100%. Meanwhile, yesterday I read that there's an office building in San Francisco that just traded 50% less than where it traded last time. And I think these two anecdotes are important. As Milton Friedman said, the plural of anecdote is data. And that is, if you read about high inflationary countries, I mean, hyperinflationary is the clearest example of it. What happens is that goods prices go crazy and asset prices go down. And what that translates to is that your wealth, the things you own, you get poorer, but your running costs go up. And that's how the middle class gets really, really squeezed. And we're not seeing, obviously, hyperinflation here, but we're seeing those trends beginning. And if you're that soap company, you probably double your price because your input costs went up, your labor costs, all those things. But your volume's going to go down. And so when you're thinking about inflation, macroeconomists, especially Keynesian monetarists, think of inflation as affecting all prices at once. Right? The debt will just melt away because all prices go up in unison. And that is not at all what happens. What happens, again, is that your running costs, your good costs go up, your asset costs go down. In terms of what gold is going to do to inflation in that case, what James and Suki described is exactly what's been occurring for the last 40 years, which is that the traders all look at the second derivative. What's the Fed going to do? And that is the current status in the market. But I think we're just starting to see a shift where the market's saying, hey, if rates go too high, then the treasury bond market blows up, right? And what happens then? The collateral of the whole planet, all the bank system, the Fed, other countries, becomes impaired. And no one has seen that happen really since the 70s, and I would say as far back as the 30s on a global basis. And so if we breach a certain level of interest rates, and why wouldn't we, given the Biden deficits and the fact the Fed's selling, the fact that China's selling, the fact that Japan may have to sell to defend their currency, there is a number at which you begin to see a debt spiral, and the market's not going to stick around and worry what the Fed's going to do. The market's going to worry about the whole market collapsing and running to gold as the only asset that is going to be left standing. And that's what happens at the end of every great credit inflation. And that's where we are. And I don't know if it happens tomorrow, next month, or next year, but that is where we're headed. And that's why gold today at near $2,000 an ounce is an incredible bargain. If you look at it in terms of the Fed's balance sheet or any other metric, monetary metric, that's been established over centuries, where the market needs to price gold to create collateral when the treasury bond market blows up.
Yeah, I actually agree with you, Dan, because when you're talking about the comparison of the real estate prices in San Francisco, I mean, people do not want to buy right now with how high the interest rates are. Obviously, as a junior gold, silver mining company, I'm very bullish on gold. I would always put that in my portfolio. However, I do it on physical gold. I do think that there's a huge opportunity if you do have a well-balanced portfolio, that if you can afford to be buying in these markets right now, the junior mining is quite depressed, as we all know, and there's a huge buying opportunity. So I'm very bullish on gold. But again, when you're looking at the interest rates continuing to go up, I don't see how you wouldn't want that in your portfolio.
I think my perspective is probably a little bit different. As a PM of a precious metals fund, I have to be invested in stocks. So that's our objective, and we have to be 100% invested. So when I think about inflation, and I look back like over the last 5 years, sort of when this whole money printing thing sort of kicked off, if you look at CAGRs, I mean, royalty cos have been the place to be. I mean, they've CAGR'd at 15% a year. Well, the GDXJ is at 4%. So things that don't have exposure to operating margin and where that inflation pressure has come, they've been better places to be. So I guess if you want to be invested in equities, I mean, holding royalty cos is a place that's pretty defensive. Obviously, physical metal as well, because that has historically been a good inflation hedge. It's CAGR'd at 10% this year, or in the last 5 years. So I guess that's how I think about it. And then obviously the operating cos, if you're going to pick something, you want something that's quality, that can absorb the inflationary pressures without having to change their mine plan.
Yeah. Will you ask questions?
Sure.
I have a question for Dan. When you go back to the 70s and the 30s, one factor that is present today that wasn't present then is crypto. So they have gold, but now you also have crypto. How does that play into the analysis?
Well, we can shift gears to this crypto panel, probably different conference. But I personally think that crypto is a fantastic bubble. I mean, it's a brilliant bubble, because in most bubble, for example, if real estate prices go too high, it's a signal of scarcity, even though it's not scarcity. It's an artifact of a bad banking system. People run and build more houses, and that breaks the bubble, right? With Bitcoin, for example, there's no supply response, and so it can go to any price. The supply response manifests in different cryptocurrencies coming in. Does it cipher money away? Well, I don't think so, because I mean, just simply crypto's risk on and gold is risk off, right? You own gold because it is a asset with no one else's liability, which crypto is as well. But the difference is that it's a long conversation. But gold, if you look at commodity prices in terms of gold, as opposed to in terms of dollars, okay, the volatility goes down. In other words, people who use gold as a monetary metric have a clearer view of prices than people who use fiat currency. Now imagine pricing commodities in crypto, right? You'd have absolutely no idea the value of anything, stocks, real estate, anything. You can't borrow in crypto, you can't lend in crypto. It's simply not a monetary medium. It's a great locus of speculation, but it's not a good monetary medium. And now, on the margin, have people bought crypto instead of gold? Sure, they have. But again, those tend to be speculators and not investors. And what you're seeing now is central banks, especially the BRIC central banks. In Russia led the way, but now China's doing it as well. They have for a while, but they're stepping it up. Are buying more and more gold, because after the U.S. stole all of Russia's currency reserves in dollar terms, no one wants to have dollars anymore. Now they need to have some. It's hard to switch those holdings overly quickly, but the obvious play is to go. If you can't have dollars, is gold. Is not crypto. No central bank, I don't think, is going to buy the crypto.
The liquidity profile of gold versus crypto is also very different. I mean, gold's the third most liquid thing in the world.
Yeah, and I think the question was a bit of a trick question too, because the inflation has already been felt in the market. So really, it's now positioning for what's coming next, which inflation is already going to be priced in. So, that's a tricky question. But it's a good sort of what Coille was saying was kind of a good segue into the next question, which I would ask her directly, and I guess also Kimberly and Dan, who really deal with the mining companies mostly. this whole idea of like resource replacement and scarcity and, high grades and, the role of exploration. Like, so how does it, I guess at this point today in the cycle, how do you see, or I guess, and for positioning for next year, right? Let's talk about making money next year. Are we buying exploration? Are you looking at high grade only? Like, how does it all kind of work in your mind in terms of this whole idea of like resource replacement, high grade miners, exploration, et cetera? Well,
sure. Go ahead. I think there's obviously a huge opportunity in the junior mining space in the sense that very few capital, not a lot of money has flown into the space in, say, the last 3 years. I think we're all very aware of the stats. It takes on average 15 years from first drill hole to production, and the probability of running that gauntlet is pretty small. And if there's no money coming in the beginning, then sort of your ability to pick better companies for me is higher because you can kind of see what's out there without having to make a knee-jerk reaction and quickly buy it. And I think that's also one of the other things we talked about was M&A, and I think that really feeds into it because at the moment it's cheaper to go buy ounces than it is to go drill them out. There's juniors that are trading at 50% below their value, a year ago, and they have twice the resources. So, the intrinsic value's gone up, but they've actually destroyed, like their market cap is down half. So it's a pretty interesting opportunity and time to buy for juniors if you are interested in that risk profile.
And do you think like the re-rating comes from the M&A activity, or do you think it comes from just general investor positioning coming into?
Both. Liquidity has evaporated from the market. It's effectively become a private equity style investment. You can get in, but you're probably not getting out. And I think obviously M&A would help put more eyes on the space and sort of substantiate that investment thesis in terms of that juniors do get taken out by seniors because they have good projects. And obviously, yes, juniors if you have the retail market provide some liquidity, I think that also gets the flywheel going. I think you need both.
Yeah, and Kimberly, you develop these assets.
Yes,
right?
I do have an opinion on this.
Yes.
I do think M&A is always going to be in our space. Everybody wants the juniors to consolidate, which is always challenging because there's too many of us. But really, what is missing from this concept is it doesn't. For me, I don't believe that it's a good concept for the majors just to buy out the juniors when the markets are depressed. Really, the better use of dollars is to help out the juniors when it's hard to fund companies by doing a strategic position in the company and maybe even have support for them when it comes to needing technical support on the side, et cetera, to help move these projects along, because we all know finding fantastic assets all over the world is still going to be extremely challenging. And, we throw a lot of darts at a wall to see what sticks. And then, we're taking on all the risk as juniors and then getting taken out by a major once we've done all the hard work of proving it out and trading for 50, 100% lower than what it's worth, doesn't help this market grow. There's a huge disconnect from that. We talked to a lot of majors, been in the space for too long now, but they just want to sit and wait because they don't want to take the risk. Well, that's not really fair, especially in how the market is set up right now. And fair doesn't play into it so much, but in order for this space to grow, we need the support of the majors to throw in 2 to 3 to 5 million into small companies that can actually make measurable progress with a small overhead, and it's all going into the drill bit. So from an aspect of a small junior company, that's what we look at to help support us to see what we can do to move the projects forward. And of course, M&A always comes out of that later. And who's the first person you're going to call? It's going to be the person that's supporting you the most, a Barrick or an SSR, whoever that is. But yeah.
Great.
Yeah, I would just say quickly that the cost of capital has gone up enormously. The cost of construction has gone up enormously. And the jurisdictions that you can build a mine and have gotten smaller and smaller, right? I mean, Africa's a mess with the Wagner Group in and all the instability and the coups there. The U.S. is a mess with the Biden administration canceling roads and having a terrorist in front of the BLM. Mexico's a mess because it takes forever to get a permit and they don't process things. Certain provinces of Canada can still business in, but my point is that the old mantra takes 15 years from drill to a mine. I mean, right now, it's hard to imagine anyone wanting to build a big mine from scratch, except in very limited places of very high-grade gold that can support that project in many environments. And what that means is that right now, it's been a killing fields of capital for juniors. But what it means is that the supply of new projects is zero. I mean, you'd be insane to start a new project today from scratch. So what that means at some point, when gold finally does run, is setting up for an enormous shortage of companies and assets and mines that will be able to market. So I think the pain we're suffering now in this space is going to be more than made up for a bidding war for these assets that's going to happen when gold finally breaks through its all-time high and starts going north.
I know, James, you have to leave in 5 minutes, so I want to give you a question. Unless you have a comment on this, do you have a comment on the miners and replacement and M&A and that kind of thing?
I've got about 10 minutes, but thank you. That's very gracious of you. The reason I have to leave early, by the way, is the combined intellectual might of the rest of the panel has intimidated me so much that I'm not worthy to be up here, especially with my esteemed colleague Suki. I would just say that we have a mining. I'm not allowed to talk about mines. Equities as such. But we do have mine supply dropping after peaking around 2025. And we do have aggregate mine production that I work with our equity analysts with gradually declining. And I do believe that'll be supportive of the gold price in general, not because it means we'll have a shortage of gold, which we won't, because there's plenty above ground, but because of the psychological factor when you start seeing things in the FT and the Wall Street Journal about more mining M&A activity having to happen or declines in production, which will lead those who are ill-informed in the market, but nonetheless maybe with deep pockets, to think that there's an artificial scarcity.
Okay. And so talking about scarcity, talking about maybe for you and for Suki to really comment on mostly, talking about sort of demand factors, what really drives the gold price, right? I mean, just a refresher for some people, but also at the same time, it's a very complex market. And so to kind of understand, there's been lots of noise about, new energy and how that's going to, support, solar panels and that's going to support the silver market, this and that. I mean, it's a lot of stuff that, it's probably on the margin. So really, can you maybe point out, maybe start with you, Suki, like, what you think is going to drive gold prices higher?
When we look at gold, we view it as both a commodity and a currency. So on the one hand, we have our supply and demand balance, and we're looking at what the changes are, whether it's scrap supply, mine supply, and then on the demand side, jewelry demand, central bank buying, retail interest, coins and bars. But I would say with the broader market trend, it's really the macro factors and the investor component that drives the upside risk. And it really comes down to the physical market and the demand response that sets the floor for gold. So the big change over the past year or so has just been the drop in ETF flows. We've seen 5 consecutive months of net outflows, but the huge increase in central bank buying. And we believe that the official sector appetite here has more than offset the net redemptions that we've seen across the ETF flows, and that's helped to raise the floor for the gold market. So when macro headwinds should have persisted, should have pressured the gold price lower, instead we've seen this floor rising higher and gold prices have held up rather well because there is a robust physical market that supports the downside. That coupled with a price elastic market from key regions such as Turkey, such as India, such as China, has really helped to increase that floor for the gold market. So gold prices are trading well above the average cost of production at the moment. And we think that we'll likely continue to see that downside risk well supported. So going forward, the question that we need to be asking is, will the market remain price elastic? Will we continue to see a solid floor? And when do these upside risks materialize to drive prices higher? In our view, we believe the official sector appetite is likely to persist. We also think that key markets are likely to remain price elastic. We've seen this time and time again, and we're currently in the midst of a seasonally strong period for consumption. But we think that there are macro headwinds that we need to keep an eye on over the next 6 to 9 months. Our base case scenario is that we don't expect the Fed to cut until the third quarter of next year. So once we think some of those macro headwinds will ease, that's when we believe we'll start to see more of an upward momentum for gold materializing.
Great, thank you.
Yeah, I would broadly echo much of what Suki said. And, the way I like to describe it is, I was in the Merchant Navy when I was young. And when you're on a ship, if the engines aren't going, that is, you think there's actually two currents in the ocean. The first one is on the top, and it goes down about 30 meters. And that's what you think is pushing the ship, and often it does. And that's hot money, that's spec money. And when I say that, that's not a pejorative term, but that's the banks trading it, that's individuals coming in and out, that's the futures markets for gold. Now, there's a much deeper, there's a subcurrent, which often goes the opposite way, by the way, and that goes down to the ocean floor. And that's much colder, and it doesn't move nearly as quickly, but when it moves, it's quite powerful. And that's what I like to think of as mine supply, official sector demand, jewelry especially. And Suki and our job is to constantly delineate and figure out, is it a strong dollar right now that's pushing gold out and a lot of specs selling it because they think rates are going higher? Or do we have such strong income growth in places that have a predilection towards owning gold like China and India that we're going to see higher prices no matter what? And our job basically is to cut through that fog, right? Now, Suki does it eminently better than I do, but nonetheless, at least I know the problem if I don't always come up with the solution. I think longer term, what you have to look at is growth in the global markets. The per capita consumption of gold is going up in the emerging world as long as income rises, and that's going to keep giving us a higher and higher floor. You spoke earlier about the 1970s. I think I'm the only one on the panel that actually remembers the 1970s very clearly. I don't remember the 30s, but I do remember the 70s. And the consumption per capita of gold was going up very quickly during that period as well. So what I think ultimately is going to be the driver, the old-fashioned things. We're not going to have as much mine supply coming out. We're going to have more jewelry demand. Central banks have clearly made a policy decision to increase reserves. Now, where we're going to get pullback is when the price goes too high and it kills off some of this physical demand and it brings on recycling. But in the meantime, the dollar is going to remain the world's reserve currency, and that's going to have a daily and weekly impact on the price, as will the fixed income market. So it's hard to say, but it looks to me right now that the physical market cannot keep up with current prices, and we have to retrace.
That's great.
And that's the summus totalis of everything I know about gold. So I'm going to leave you right now. Thank you very much, everybody.
Thank you, James.
I'm just going to quick just a nuance on that view, which is that, I mean, you need to open your horizons a little bit and remember gold's been a currency for 2,000 years. And empires have come and gone, and they've had currencies, and they've debased their currencies. Almost every powerful country does because they can, and they do, and then the currency collapses. And gold persists. And so when you ask what's going to drive gold higher, I've always said that's the wrong question. The question is what's going to drive the dollar lower? Because really the dollar price of gold is a reflection of the dollar, not of gold. 98% of mining produces 2% of the above ground supply every year, more or less globally. And so when you buy an ounce of gold, you're really buying it from someone else. You're not buying new supply. So looking at it in terms of commodity, the way you look at oil supply and oil demand, and you produce oil and you sell it and consume it 9 months later, it's a totally different market. I mean, this is a total supply versus total demand, not marginal supply versus marginal demand. But that creates the enormous stability, which I talked about earlier, the fact that when you price commodities in gold, volatility goes down. And so again, to judge where the gold price is going, what you should do is look at the Federal Reserve's balance sheet, because what the dollar really is, at its essence, is a unit of liability of the Fed. And so there are two ways to value that thing. One is, what's the demand for that to pay interest rate and amortize all the debt that people have around the world. That's the first thing to look at. The second thing to look at, what are the assets the Fed holds to back that liability? And the assets are pretty crappy, right? I mean, they have fixed rate 10-year Treasury bonds that are down 30, 40%, and they have mortgage-backed securities, which have lengthening duration as rates go higher because no one refinances. And so the Fed, last time I checked, they're not just losing, they've lost $100 billion in operating losses in the last 12 months, but they've lost over $1 trillion in capital losses. So it is a disaster of a balance sheet. And when you own the dollar, that is what you own essentially. And the more the market figures it out, the more they say, well, we don't own this. And if you were like in Argentina, you might say, well, I'll buy the US dollar instead of pesos. But when you're in the US, there aren't that many other currencies to go to besides gold. So I think that given that reality, it doesn't really matter what the Fed does. If they start printing the money again, inflation's going to kick up and they'll lose control of the long end of the curve, right, which is what they own. And if they don't, then the long end goes anyway because of the deficits that Biden is printing. So, I mean, it's hard to see how the Fed gets out of the box that they put themselves in.
Yeah, I mean, the dollar's in a very, as you pointed out, I mean, it's obviously one of the big sort of headwind on the gold price. And also, the US dollar versus, we're owning a lot of Canadian currency and we're owning a lot of Australian currency as well. Right, so you kind of get hit twice. So would love to it's a good maybe point to, I don't know, Suki, if you want to talk about sort of U.S. dollar. Do you do analysis on U.S. dollar, and then how do you where do you see that now sort of historically, and where do you see it going next year?
I think the dollar's been a significant headwind, not just for gold, but the commodities complex as a whole. And one of the challenges that the market has had is predicting the peak for the dollar strength, and that has continued to be pushed out. We had a period where we believed that we were seeing US exceptionalism, whether it was in terms of the economic recovery or equity market outperformance or interest rate differentials. And we've now moved to a period where we thought we would have started to have seen the rest of the world starting to catch up in terms of economic growth, but that hasn't really materialized. So our house view now is that we'll continue to see persistent dollar strength for the next couple of quarters. And our FX team believe that against the euro, we'll see the dollar at around 1.04. And that, we think, will continue to cap the upside momentum for the gold market. And it's interesting to note that the correlation between gold and the dollar remains strong. We've had periods this year where the 3-month rolling correlation's been in excess of 60%. That has now come down to about 38, 37% over the past week or so, as we've seen gold benefiting as a safe haven asset, but not necessarily the dollar benefiting as a safe haven. So we've seen somewhat of a divergence, but it's not unusual to see periods where the dollar can firm and gold can firm if both are benefiting as a safe haven and benefit from flight to quality. It's not happening at the moment, but there have been periods where it has in the past. So our view is that, yes, we'll continue to see the dollar strength. It's helped in terms of the cost of production for many companies. It's meant that the average all-in sustaining cost of production is still well below current price levels. But we do think that it's going to become less of a headwind towards the end of next year.
And I guess Coille or Kimberly, do you have any views on U.S. dollar or Canadian currency, or Australian currency? You're dealing in all of those usually.
Well, just on a layman's term, being a Canadian company, raising Canadian dollars and then converting it to working in Nevada, it's really not helpful when it's hard to raise funds as we sit today. And then, we just raised just $2 million recently, and then you convert that to 1.3 by the time you're done paying fees and everything else. It doesn't get very far for a junior. So we'd love to see it be at the par state like it used to be. It was great because we could actually do our work. That's just low level.
For me, actually, it's a bit different because if I see an Aussie with, I think the Australian dollar's at 67 cents right now. It's come down. Most of their op costs are in Aussie dollars, so there's a natural hedge between what they're selling in USD and what they're producing at. Same goes for Canada. So when you see weaker currencies versus USD, it's actually generally means there's going to be operating margin expansion versus compression. So you could, over time, you can trade that in terms of where the currencies are.
Dan? You were going to say something?
Well, no, I was just going to say that, I mean, they're all going to zero. So when we look at FX trades, the only question, which goes to zero faster? And I mean, it's not, I mean, to say that dollar strong just means zero is a disaster, which of course it is for lots of reasons. And Canada, interestingly, Canada's never really had a real estate crash. And that's because the banks were not permitted to hold mortgages until about 20 years ago. And then that rule changed. And now Toronto and Vancouver have the most ridiculous bubbles, I think, in the world today. And so when that pops and crashes, what's Canada going to do? So I don't think that when you think of it in those terms, the Canadian dollar is going to do so well. And I'm less familiar with Australia. My understanding is from my Aussie friends that the real estate prices there are also crazy. So do they do a 1930s and just say, oh, sorry, and let real estate prices go down 50, 60, 70%? Or do they lean on the central banks to print the money and keep the nominal prices constant and then have massive inflation? All of Keynesian thought argues for the latter. Right? I mean, the lesson in the Western world, which we still reverberate the Great Depression, is don't let the banks go down. I had a dinner many years ago with a CFO of a Swiss bank, and she told me in Germany it's the opposite, right? Because they had hyperinflation. Like, let the banks go. You don't want the currency to go. Here it's save the banks. And so again, I think the currencies will get it next time there's a big crash. And don't forget, I mean, if you look at the context here. In 2008, the private credit markets blew up. And the central banks from the world said, we'll save you. And they went in and they bought these mortgage-backed securities. They bought the treasury bonds. They financed these enormous deficits. And so now we have a situation where the central bank's balance sheets are a disaster. And so again, I go back to when they fail, and they will, because it's math and it's economic law, what happens? And the answer is, well, anyone who's still solvent is going to start buying gold. And the governments will start printing money, and they won't have the fig leaf of saying, "Well, we won't accept losses," or all things they usually talk about. They will have to print the money to buy the government bonds because no one else is going to buy them in this context.
Thank you.
On that note, buy gold.
So we've talked about gold for most of the time here. I just want to switch gears for a minute, talk about silver. And sort of how you see that market and what your view is on that market in terms of its pricing and maybe some of the some of the supply demand dynamics of that market that have been also been changing, I guess, supposedly here recently. And so maybe I'll just start with you, Suki, if you can just give me your view on silver.
I find silver to be an incredibly fascinating market. It's one of the ones that I enjoy analysing because there are so many fantastic end uses, whether it's water preservation, whether it's water purification, or whether it's electrification of vehicles. There's so many great end usages, but the trouble is a lot of these usages are quite small. So it doesn't really move the dial when it comes to supply and demand dynamics. The big change that we've had over the past decade or so has really been silver's use within the photovoltaic sector. And that's an area where we've seen demand growing by threefold. And that's helped to replace some of the lost consumption when we think about the market for photography for silver. But in terms of a supply and demand balance, the silver market is very well supplied. And silver is a hybrid metal. It sometimes tracks in the footsteps of copper, where its industrial component takes the forefront, or it behaves like a precious metal and the investment element is incredibly strong. What we've seen over the past year or so is that it hasn't really benefited from the same drivers that gold has. And I think that's partially because the central bank element has been so important for the gold market. So we haven't seen that same upward interest or upward risk for the silver market. The other element that was so important for silver over the past 12 months was the replenishing of stocks in India. And we saw record imports of silver going into India. And that helped to support the market last year. But that has stepped back now as well because much of that restocking has drawn to a close. We think from an industrial standpoint, the silver outlook is very strong. Just thinking about electrification of vehicles or rollout of a 5G network or the use of silver in solar panels or wind turbines, there's a very strong link to the green energy market. And we think that's going to continue to be very strong. We also think that supply is likely to continue to grow at quite a healthy pace for the silver market. So we don't think that there's going to be an imminent shortage of silver. But equally, we don't see the same support on the downside for the silver market that's driven across other commodities, such as from the cost of production, because the average cost of production for silver is just so much lower compared to where silver prices are trading. So having said this, we think it's going to be at the mercy of some of the macro headwinds that gold faces. But we do think that over the longer term, we're going to see robust industrial demand continuing to grow and reaching fresh record highs. And over the longer term, we believe that will help to push silver prices higher. But over the next 12 months, we think it could be quite choppy for silver, perhaps even true to form, continuing to be more volatile than gold.
Coille, what's your view?
I think the silver market is tricky in the sense that about 70% of silver comes as a byproduct. So there's very few silver predominant mines in the world. So lead and zinc don't often correlate with silver, and so the decision to produce lead and zinc, and so silver just comes along for the ride in terms of being produced. And so it's not like there's a great supply, I guess, effect when silver prices go on, because most of it's being driven by lead and zinc prices. So that dynamic is in itself just hard to isolate, because you can't really predict what the supply is going to be. But I agree, the volatility of silver versus gold is sort of at all-time highs. So if you're looking for torque, then silver is obviously a better place to be. It's such a small. It's also a very small market relative to the gold market. So a small change in the silver market has a very big ripple effect.
And we've talked. I guess the silver people talk about like this ratio and like it jumping back to that and that kind of thing. And so like. Dan, do you have a view on that? You have a view on?
Yes, I do. So if you go back into history, gold was a currency, but still silver was everyday currency. So if you wanted to buy a ship or ransom your king back, you did it with gold because gold was so valuable. If you went to the market to buy tomato, you wouldn't use gold because it's just too much value. So silver was actually the everyday currency. And so if you think about it in those terms, in the 30s, when the U.S. bank system blew up, there was no problem with U.S. currency. And gold did very well. Silver was a disaster because no one needed an alternate currency for day-to-day transactions, as it were. In the 70s, it was the opposite. Right? You had a credit problem, but an inflationary problem. And I hear stories from coin dealers in New York City that cab drivers and laundromat people would show up in the day with their dollars and say, I want to buy silver because I don't want to hold these dollars for any length of time. And so silver reestablished its role as a quasi-currency. And so for me, gold is when a credit collapse, whether it's deflationary or inflationary. Silver only does well if the credit collapse is inflationary. As I mentioned earlier, I'm pretty sure it's going to be. So I think silver is going to do very well. And to reiterate the comments earlier, when that happens, industrial production will not benefit. And so these these lead and zinc mines will close. That will That will shrink the silver supply. It doesn't matter what happens to the price of silver because they're byproducts. And so you can have a situation where the demand for silver goes up because of monetary elements. And also the solar panels, again, and a major problem, industrial activity will shrink. But my understanding is that the Chinese, not that I ever want to bet on the Chinese economy, given the bubble it's in, but for them, solar panels is a national defense issue because they import most of their energy. And so every solar panel they build is one little less energy they need to import. So for them, it's a political decision. So they are consuming huge amounts of silver to build out solar panel networks. But at the end of the day, the currency demand will determine its fate. And if we have an economic crash, then the supply is going to shrink whatever happens to the price. And that sets up an enormously bullish scenario.
So just a couple of minutes left. I guess ask a question that's kind of pertinent to the conference today and the investors that are here and the companies that are here. If we were to grab, everybody's got their reasons for not liking a benchmark, but if we were to grab a benchmark, right, and we look at it from now until the end of next year, let's call it the next 12 months, let's grab a gold benchmark because we're talking about precious metals, right? We're talking about precious metals benchmark of equities, okay? So Suki, maybe put on a different hat on for a second to give me the answer, but where do you think we are today, and where do you think that benchmark is what do you think that benchmark will look like in terms of performance this time next year or December 2024? So let's grab like GDX, right, or MSCI, or but that's kind of all world. Let's grab like a GDX or something. Where do you think GDX versus today and 12 months from now, do you see it up 10? Do you see it down 10? Where do you kind of see like just the mining complex, the precious metal mining complex finishing in 12 months from today if you were to be investing $1 today? Coille?
I mean, I guess as a benchmark, I would say if I believe the gold price is going higher, then I would pick the GDXJ because there's just more operating leverage in that index versus the GDX or MSCI.
Sorry, I guess my question is not like which benchmark would you choose, but like choosing any gold benchmark.
Yeah.
If you were investing $1 today, do you think that you think that you're going to make a return of what do you think your return is going to be, negative, positive, and then sort of in what range? Do you think these equities are going to revalue or devalue?
Crystal ball here?
Well, this is all the part of the fun of it because like we're all speculating here, so we're all investing. So
I think in 12 months the U.S. should be showing signs of a recession. So I would think that the gold price would be trending upwards. So I would say let's pick the GDX up 12.
Okay, Kimberly.
There you go.
Well, I hope that the market turns around in the next 12 months. I mean, I don't think a lot of people saw this lovely war that's happening in Israel. So there's a lot on the table. We've got the U.S. situation with the presidential campaign coming up with two crazy sides of the campaign to deal with. But yeah, I mean, I do think gold will be up. How much, I'm not even going to begin to speculate on. But
you think the equities will perform? Because sometimes gold price goes up.
I think they'll perform, but I don't think it's going to be as much as we hope they'll be. I think it's going to be a modest performance.
Okay.
Yeah, I view gold equities, especially juniors, as insurance contracts. So you're probably going to lose a little bit of money every year, but you hold them because there are years like 2016 or 2009 where they go up, not 10%, but 4 or 5x, right? Or the juniors can go more than that. In the 70s, there were instances of companies going up 50, 60x, right? And so that's why you hold these things, is not to make a return next year, is to have an insurance policy against the failure of the central bank's monetary experiments.
I'll comment on a commodity basis. In terms of our mine supply production projection for 12 months' time, we think it will continue to grow. So we think overall global production will be firmer than it is for the quarter this year. And in terms of price action, I wouldn't be surprised if we're looking at a very similar range to what we're trading today. But we think between today and 12 months' time, we will have seen prices under pressure before then.
Great. And I think that's it. So thank you all very, very much for the questions and for answering them and for being here today. Thank you.